Achieving retirement in 10 years is not a far-fetched dream. It's a goal that can be calculated, planned, and executed if you approach it with discipline and a clear strategy. When you combine personal discipline, long-term commitment, and the right financial strategy, retiring in 10 years stops being a vague idea and becomes a solvable equation. This has nothing to do with age. Whether you're 25, 35, or 45, whether you're starting with significant savings or almost nothing, the outcome is still achievable if you follow a structured and sufficiently aggressive financial roadmap. But before we talk about action, you need to understand the core financial principles and calculations behind this entire strategy. Those numbers are what turn retirement someday into a plan that's specific, measurable, and controllable. And be honest with yourself. Do you actually know how much money you need to retire? Most people can't answer that question, not because they don't care about their future, but because they've never turned retirement into a clear number. If you genuinely want to stop working for money within the next 10 years, if you want to know whether you're ahead of schedule or falling behind, and if you want a plan you can validate with real numbers, stay with me until the end of this video. By the end, you'll have a clear framework to build your own retirement plan, based on math, not guesswork. If you're serious about retiring within the next decade, this video will show you exactly what to do next, step by step. I won't disappoint you. Retirement is not a feeling. It's a number. The biggest reason most people never retire early has nothing to do with income or work ethic. It comes down to one simple problem. They never define a clear retirement number. When asked, how much money do you actually need to retire? Most answers are vague. As much as possible, enough to live comfortably, or probably a few $1,000,000. Those answers may sound reasonable, but financially they're useless. Because when you don't know exactly where you're going, every saving and investing decision becomes guesswork. The materials behind this 10-year retirement plan are built on a very simple but critical principle. Early retirement only becomes possible when it's turned into a calculation. That calculation is straightforward. Annual retirement spending x 25, a hard target portfolio size. This isn't a random formula. It's based on the 4% safe withdrawal rule, a concept that has been tested across decades of financial research. For example, if you need $40,000 per year to cover your living expenses in retirement, you need a portfolio of about $1 million. If your annual spending target is $50,000, the number becomes $1.15 million. And if you want $100,000 per year, you're looking at roughly $2.5 million in invested assets. The key point isn't whether those numbers feel big or small. The key point is that you've now turned retiring someday into a measurable target. Once that number exists, everything changes. You stop asking, should I save more? And start asking, how far am I from my target? You stop investing based on emotion or headlines and start evaluating every financial decision by one simple standard. Does this move me closer to my retirement number or farther away from it? Early retirement doesn't happen on the day you feel financially secure. It happens the moment you can look at your portfolio and know, with confidence, that these assets can support your life without requiring you to sell your time anymore. That's why every serious 10-year retirement plan starts by defining your number first before talking about saving rates, investment strategies, or cutting expenses. Because without that number, there is no plan, only hope. Point 2. The 4% rule. How to live off your assets without running out of money. Once you've defined your retirement number, the next critical question is just as important. How do you live off that money without worrying that it will slowly disappear over time? This is where the 4% safe withdrawal rule comes in, and it's the foundation of the entire 10-year retirement plan. The rule is based on a very practical assumption. A properly constructed investment portfolio can reasonably earn an average return of about 7% per year over the long term. From that return, you withdraw 4% each year to cover living expenses and leave the remaining 3% invested to offset inflation. In other words, you're not spending all your returns. You're only spending what you need to live, while the rest protects your purchasing power over time. The key strength of the 4% rule isn't about maximizing returns, it's about sustainability. Many people assume that retiring early requires taking extreme investment risks to make as much money as possible. In reality, the greatest risk in retirement isn't earning too little. It's withdrawing money the wrong way. If you pull out too much during a market downturn, your portfolio may never fully recover, even if the market rebounds later. The 4% rule is designed specifically to avoid that outcome. It assumes worst-case market scenarios, long periods of economic downturn, and still allows the portfolio to last for decades. Once you understand this, the X25 formula stops feeling arbitrary. It becomes a safety boundary between living off your assets and unintentionally eating into your principal. More importantly, the 4% rule completely changes how you view money. You stop seeing your portfolio as a balance you slowly spend down, and start seeing it as an income-producing system similar to a job, but one that doesn't require your daily presence. From a financial standpoint, retirement isn't about stopping work. It's about reaching a point where your income no longer depends on whether you show up to work or not. And the 4% rule is the bridge between those two states. From living on a paycheck to living on assets in a controlled, disciplined, and sustainable way. The 65-35 portfolio, managing risk for the long run. After defining your retirement number and understanding sustainable withdrawals, the next question is, how should a portfolio be built so it can both grow and survive the worst market conditions? The answer offered by this 10-year retirement plan isn't take more risk. It's intentional asset allocation. The proposed structure is very clear: 65% stocks and 35% safe assets. The 65% stock allocation serves as the growth engine. Over the long term, the stock market has delivered an average return of about 10% per year, based on historical data. This is the component that allows the portfolio to grow fast enough to reach the retirement goal within 10 years. But growth alone isn't enough. If a portfolio is concentrated entirely in stocks, the biggest danger isn't low returns. It's volatility. A single major market crash at the wrong time, especially while withdrawals are happening, can derail the entire long-term plan. That's why the 35% allocation to safe assets plays such a critical role. This portion is typically held in high-yield savings accounts or other stable assets, with a modest expected return of around 1.5% per year. At first glance, that return may seem unimpressive, but strategically, it provides three major benefits. First, it reduces overall portfolio shock during periods of market turbulence. Second, it creates a psychological buffer, helping you avoid panic-selling growth assets at the worst possible time. And third, during periods when interest rates rise, this safer allocation can contribute meaningfully to total returns, without taking on additional risk. When the two components are combined, the math becomes clear: 65% x 10% plus 35% x 1.5%, 7% average annual return. This portfolio isn't designed to beat the market, it's designed to get you to your destination. Because in a 10-year retirement plan, the most important factor isn't how much money you make in any single year, it's whether you can stick with the strategy long enough for the goal to become reality. And the 65-35 allocation is the foundation that makes that possible. The three non-negotiable pillars. This 10-year retirement plan doesn't fail because it lacks formulas or investment tools. It fails when people don't fully commit to its three foundational pillars. These pillars aren't suggestions, they're requirements. Remove even one, and the entire 10-year timeline collapses. The first pillar is aggressive saving. To achieve financial independence within a decade, average saving habits aren't enough. This plan calls for saving 30% to 50% of income, or even more in the early years. That requires a fundamental mindset shift. Saving is no longer what's left after spending. It becomes the first priority for every dollar you earn. Only when cash flow is redirected this way does the portfolio have enough fuel to grow at the required pace. The second pillar is optimizing income and investing. High savings keep you on track, but rising income is what compresses time. Spending has limits. Income doesn't. That's why the 10-year plan emphasizes career growth, seeking advancement opportunities, and building additional income streams, especially ones that can continue even after you stop working full-time. At the same time, capital must be placed into appropriate investment vehicles, not to chase short-term wins, but to generate stable, repeatable returns over many years. The third pillar, often the most underestimated, is strategic spending reduction. Cutting expenses doesn't just increase savings today. More importantly, it lowers your long-term cost of living, which directly reduces the retirement number you need to reach. Lower living costs mean a smaller required portfolio. That alone makes the 10-year goal far more achievable. A critical part of this pillar is avoiding lifestyle inflation, the tendency to spend more as income rises. This habit quietly forces many high earners to work far longer than necessary. These three pillars don't operate independently. They reinforce each other. High savings build capital. Higher income creates speed. Lower spending provides a margin of safety. When all three are applied consistently, retiring in 10 years stops being ambitious and becomes a realistic, achievable roadmap. The 10-year execution roadmap. Understanding the numbers is the starting point. Having a strategy is necessary. But what ultimately determines whether you retire in 10 years is how you execute the plan year by year. This roadmap doesn't require one dramatic breakthrough year. It requires doing the right things at the right time for long enough. Year one is about laying the foundation. The goal isn't complex investing or maximizing returns. It's gaining complete control over cash flow. You build a detailed budget, understand money in versus money out, and begin saving with discipline. A practical approach is starting around 20% of income, then increasing monthly to reach 30–40% by the end of the first year. This phase builds habits, the kind that last all 10 years. Year 2 shifts focus to increasing income. Once saving habits are stable, every extra dollar earned has outsized impact. Career advancement, skill expansion, or building a side income accelerates accumulation without adding investment risk. More importantly, you're building future flexibility, the ability to earn even without full-time work. Year 3 is about optimizing investment efficiency. Your money no longer sits idle. The portfolio becomes properly diversified, potentially through automated platforms, indirect real estate, or tools that improve ROI without requiring daily market monitoring. The goal isn't more risk, it's better performance from the same capital. Year 4 focuses on cutting major expenses. This means confronting big costs like housing and transportation and adjusting them to more reasonable levels. Doing so frees up more capital to invest and helps you adapt to a lower-cost lifestyle aligned with retirement. From years 5 through 10, the biggest threat is no longer lack of knowledge. It's complacency. As assets grow and pressure eases, discipline tends to slip. This phase requires staying the course, reviewing progress regularly, and making small improvements across saving, investing, and spending. Those small improvements, repeated year after year, are what ultimately get you across the finish line. This 10-year roadmap isn't flashy, but when executed consistently, it turns financial freedom from a vague idea into a predictable outcome. That's the real difference between dreaming about retirement and having an actual retirement plan. This entire 10-year retirement plan isn't based on luck, emotion, or waiting for someday. It's built on clear numbers, a structured strategy, and consistent execution over time. If there's one thing you should do immediately after watching this video, it's not opening an investment account, and it's not searching for the next hot opportunity. It's defining your retirement number. Ask yourself, how much money do you need each year to live comfortably? Multiply that number by 25. That's your target. From that moment on, money stops being vague. Every saving, investing, and spending decision has a clear benchmark. Does it move you closer to your goal or farther away? If this approach helps you see money more clearly, subscribe to the channel because the next videos will walk through each practical step of this roadmap in detail. And before you go, leave a comment. What's your annual retirement number? Just one number, but it's the first step toward turning the next 10 years into a real plan.